Hi, and welcome to this episode of OmniTalk Global. Today, the topic for today is Charlie Munger's concentrated portfolio, and so we are going to talk about portfolio diversification, how much of diversification is required, what is a concentrated portfolio, what is a focused portfolio, and what is a over diversified portfolio. And this is something that it worries a lot of investors, and I think a lot of even professional fund managers are not clear about this. So I have my colleague Dr. Vikas Gupta with me, and we are going to start with how concentrated is actually Munger's portfolio.
Yeah, so all this whole story of a very focused, very concentrated portfolio started from Charlie Munger, right? That's why it's become so famous and popular. And he claims that he has only 3 stocks in his portfolio, and those 3 stocks are Costco, which is a retailer, right? A discount retailer, extremely strong company. Number 2 is Daily Journal Corporation, which is a newspaper holding company, but then it has a lot of investments as well. So 4 or 5 stocks are there inside Daily Journal, some banks right now. And Charlie Munger is the chairman of that company. And then third one is Berkshire Hathaway, which Charlie Munger is the vice chairman. And we all know, Warren Buffett is the chairman, and how many companies it holds.
Right. It's very, very diversified.
Right? I mean, around 50 listed companies and 70 odd unlisted companies, maybe even more.
Right.
So that one single company is more than 100 investments. Daily Journal is 4 or 5 investments.
Right.
And then Costco is fine, it's a single company. And then there is a 4th investment of Charlie Munger, which is in Chinese investments in Lilu's partnership, which is another fund manager with right. So that again we would assume at least it would have 3 to 5 stocks, even if he follows Charlie Munger's same concentrated portfolio philosophy, right?
Right.
So all in all, Charlie Munger is invested in more than 100 and maybe 120, maybe 130 stocks.
Right.
Okay. So, but he claims 3 and it looks like 3. And people get confused, and then they want to pick that one single multi-bagger or 100-bagger or what, and so on, and that creates a lot of confusion. It was great in an earlier era when there was huge transaction costs. Maybe brokers charged 2% or so,
Right.
and there was a lot size limitation, so you had to buy a certain minimum size, and there is transaction cost, there is taxes. And so, and maybe the companies were also, economy was also very stable. Companies had a lifetime of 50 years plus.
Right.
Okay, on the S&P 500. Today McKinsey says it's less than 18 years, right? So, given all of that background,
Right.
it made sense, but it doesn't make sense actually.
Correct.
And also we have shown that Charlie Munger is doing something else. He's asking you to do something else, but he's doing something else.
Right.
Okay, so I would do as Charlie does rather than do as Charlie says, right?
Correct. Right.
Yeah.
So that's a bit misleading, I would say. But so as per what we have looked at, what is our understanding in terms of what research says, or what as we have been practicing for years. What do you think is the right kind of portfolio diversification?
Yeah, so see, there are studies which show that anything above 50 stocks is more or less similar to S&P 500, right? In terms of volatility. It comes very asymptotically close, it comes very close. So beyond 50, it doesn't make sense to diversify from volatility point of view. Okay, and practically if you say 50 and it is reasonably diversified across industries, etc., and weightage wise also it's fine, then it's as diversified as the full market practically.
Yeah, but tell me one thing, because so there is a notion that on 2 things. One is that your 10th idea cannot be as good as your first idea.
Absolutely.
Right? Plus that if you have a very focused approach and you know what you are doing, and you are not just spraying and praying that something will hit, and because of that you should have concentrated portfolio.
Sure.
Second line of thought is that typically diversification reduces risk. So, and then low risk is low return. So the contrary of that should be true, that if you make it concentrated, you are kind of, it's a high risk, high return. So if you want to target something high return, you have to go concentrated, right? So that is something that I think we don't believe in, and we have a very different view on that, right?
So first of all, I mean, yeah, you are doing weekend investing at home, and you say, okay, whenever I have free time, I'll research some stocks.
Correct.
Then I understand that the 10th idea might not be as good as your first idea. And you anyway are going to come across very few compelling ideas, right?
Correct.
Extremely undervalued, very high quality companies and so on. But if you are full time doing this, it's our experience, right? I mean, we've been doing this in US markets, Indian markets, European markets, UK markets, Japan.
Right.
And even at the peak of a bull run, we've been able to find a large number of mispriced stocks.
Sure.
Right? In every cycle we have seen.
Right.
And so, if you are going full time, you can actually have a deeply researched list of very large number of stocks. I mean, very large in the sense what we call a focused portfolio.
Yeah.
Okay, something between 20 to 50 stocks.
Right.
Okay, ideally 25-30 stocks. Okay, but when markets are low, you might go as high as 50. When markets are at bull run, you might be down to 20 or 25. Right? But we have always been able to find 20 to 25 stocks. In fact, we had to reject even during any bull run.
Right.
We had to reject stocks, not to have a overloaded portfolio. So the 10th idea can be as good. Secondly, you don't know whether your first idea and the 10th idea, what is the difference?
Right.
In terms
and
of
when it is going to work out.
When it's going to work out, you can have expected returns of more than 40%, depending on when it unlocks, maybe in 3 to 5 years. We have had ideas which are 35% kind of expected returns, right? CAGR basis, if it unlocked in 3 years or 5 years. Now, or 5x, 5 baggers or something. And we cannot say, I mean, under certain conditions, the first idea could be a 5 bagger, or it could just be 20% CAGR under some other scenario. And my 10th idea could be a 10 bagger under certain circumstances, and maybe a 15% CAGR compounded, or 25% CAGR. So there is a lot of uncertainty, and there is a range of possible outcomes depending on which scenario works out. So it's very difficult to say that the first is better than the 10th.
Right.
Okay.
So I agree. Typically, there is a belief for people, kind of accept the fact that there are not enough investment opportunities, or at least they cannot find enough investment opportunity. So whatever they have found, and that they should put most of the money right there.
That also is a wrong notion. I mean, even if you you can't put more than 10% in a single stock. That absolutely doesn't make sense.
Right.
Okay. If you don't have, then you go for a fund manager, right?
Yeah. And even then, certain fund managers will have, some certain kind of screening parameters, which basically leaves them only 15-20 companies to invest in, right?
Yes.
And then they said that, then there is no other way to, being more concentrated than more diversified.
Right.
So there is probably a flaw, but we are at least able to find, sufficient investment opportunity.
Absolutely.
So on the return side, because can you kind of touch upon the VC orientation, and how can we position ourselves to catch a golden swan, right? When we are going a diversified way.
So first, let's define black swan. Black swan is very rare but highly negative impact event, right? The magnitude of the impact is very negative. That is called a black swan. Same way we define golden swan as something which is equally rare but has a very high positive impact. Okay. Now venture capitalists are trying to do this all the time, right? They want to catch golden swans in their portfolios. And once in maybe 10 funds they launch, they will catch a 10,000 bagger, right? Like a Google or Facebook or something like that. Excuse me. And the whole idea of VC is to have that in the portfolio. So a typical institutional investor in venture capital funds will invest across every scheme they come across, right? From the reliable, the high caliber VCs. They will invest in every series, everything, something, so that they have access to some allocation to that potential, 10,000 bagger or whatever. Same way. So and a single fund also would have something like 20 to 25 investments.
Sure.
The idea is that by adding more stocks, you are increasing the probability of that catching the golden swan. And that is what you want to do here.
Right.
Okay.
Sure.
And so you need a certain number of stocks in the portfolio.
Sure. So it increases your chances of catching those
Catching the golden
opportunities.
swans.
And there are such opportunities, multi-bagger opportunities that keep coming up, and
Right.
seen many in our portfolios.
And many silver.
Swans, if not,
So everything need not be a
Right.
golden swan, right?
Right,
So silver
absolutely.
swans and
Yeah.
so on, which is good enough.
So just to conclude, because let's also talk about the other side of the diversification, which is less understood, is in terms of just having enough number of stocks is not sufficient. You need to have, like when you are orienting yourself to a diversified portfolio, we talked about a focused approach where we, you're looking at 20 to 50 stocks. But and that the allocation has to be well balanced. You cannot have very skewed allocation that
Right.
you might have 25 30 stocks, but top 5 will take 80% of their money,
Doesn't
right?
make sense, yeah.
So that is again a very skewed approach. You might think that you have well diversified portfolio in terms of number.
Right.
The second thing is, I think, your exposure to be different growth vectors which are like less correlated,
Right,
or maybe
absolutely.
uncorrelated, so that you are getting benefit of being exposed to
Diversified
things which are
portfolio of growth vectors.
Yes.
Absolutely.
So I think that is also very important.
No,
when you-
absolutely, absolutely. So stock diversification, people know, industry and sector diversification, but growth vector diversification is very critical, and that is what we try to practice here
Sure.
at OmniScience.
Great. I think with this thought, let's conclude. Thank you so much for joining.
See you next time.
So always keep in mind that investment in securities market are subject to market risks. Read all the related documents carefully before investing. And also that registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.